Okay, remember that business activities are measured in monetary terms, okay? And then, so long as you can measure it in monetary terms, they either get categorized eventually as, let's say, either an asset or what? Liability, or let's say income, or let's even say expense. Okay? So what I'm saying is that, as activities happen, and then we capture it as accountants in monetary terms, we categorize them eventually based on the way they behave as either an asset, liability, income, or expense. Okay? Basically. Alright? Now, we must also understand that various accounts that we open, sales, purchases, land and building, motor vehicle, transportation, capital, and all that, okay, they all form each of these. Your sales, for instance, is an income item. Your transportation is an expense item. Okay, your land and building is an asset item. Your cash is an asset item. Okay, and creditors is a liability item. So as you open these ledgers, okay, they are categorized under each of these heads. And then if you're used to a software environment, there's something we refer to as chart of accounts. Okay, the chart of accounts is let's say the various ledgers open to capture monetary transactions as activities of the organization occur from time to time. Okay, and then this chart of accounts are categorized as assets, as liabilities, income, or expenses. Okay, now but what I'm trying to achieve here today is to let us understand that some events, there are some occurrences that happen from time to time, such that there could be a sort of economic outflow. All right, and then management in most cases want to take steps by form of adjustments, okay, to cushion the effect of these occurrences, okay, on cash flow or bottom line, okay, and then as well to have a fair implementation or regard for the what I call money measurement concept, and then what we call the prudent concept as well. You see, so the point I'm trying to make is that in order to have an accommodation for these events that occur from time to time, such that the outcome can have an effect, okay, on the report for the period, okay, and then in order for us to accommodate that, most times management use what we call provisions. Okay, so basically I've taught a class on provisions, okay, but we're trying to have what they call a bit of an exercise on provisions again, so that we can understand its practicality, okay, for accountants basically. So what I'm trying to say next is that there are some occurrences, okay, that as an accountant you must find a way, okay, to accommodate them, so that you don't eventually give a false impression of maybe the bottom line or maybe the cash flow, okay, that you're presenting to what management. Of course, when you present a very sweet profit, in that sense, management will want to spend. When you present, what do you call it now? A fair position, that is in line with the prudent concept, it puts management on check as regard, spending. Although, of course, there are some costs that you have to incur, especially when the value will eventually give, a very good impression about the brand that you're creating. Okay, sometimes goodwill, for instance. Okay, sometimes you want to create a value that gives the impression of profitability of a business. So sometimes you spend to get those value, but that is also in one aspect. What I'm trying to say is that there are some occurrences that can even result into sort of losses, possible losses. Okay, so in order to give a fair view of the activities of the business, you make provisions. For instance, in the bank, there's something called the prudential guideline. Okay, because the bank basically is actually in the business of what? Of taking risk, and is giving out loans that of course you're going to take the necessary measures to avoid loss of fund, but there's still the risk of losing the money. That is, the person that you're giving the money to in form of advance, okay, might not pay back as and when due. Of course, non-performing loans has actually affected some banks, okay, over the years, and even in recent times, even whichever we look at it, there's still some challenges with non-performing loans, especially with this COVID-19 saga. Businesses are actually finding difficult, to do their usual remittances in terms of repayment of loans. But that's not what we're discussing. I'm just trying to tell you that such occurrence, for instance, okay, where the customers, that's your clients that you've given out loans to, that you have sold on credit to, it is possible that their behavior in terms of payment or paying back or paying their dues might be affected, such that the activities to be reported, okay, if not properly adjusted for to accommodate these possible occurrences, okay, you might be given a false position, okay, of the performance of the business. So basically what I'm trying to tell you is that there are some items, some occurrences that an accountant is expected to accommodate in form of provision. So you make adjustment by providing for the possible occurrence of that very item, such that when you report the activities of the business, okay, such item, even when disclosed and when captured, does not give a misleading impression to the users of the information. So basically, in this class we are trying to look at how to make provisions. Okay, now remember that you have liabilities, which means that you are owing external individuals or external parties. Okay, that means you have obligations to settle. And then we have assets, okay, that has to do with resources utilized for productivity, okay, to generate more income and all that. Then we have incomes, okay, earnings. And then we have expenses, expired costs. That is, when you incur a cost and it expires within the period, it's an expense. What I'm saying is that typically when an occurrence or when a particular event is occurring, and then we can predict the outcome, by the time we make provisions, it can be resulting into an income or resulting into an expense. So in this class, we're going to be making or paying attention to provisions we made for items that can result into an income or an expense. And of course, don't forget, in the recognition of provision, there's something called contingencies. Okay, we call them contingent liabilities or contingent assets. Okay, so you should look at your International Accounting Standard. Okay, standard 37. So IS 37 there, gives us the recommendation of the board regarding provisions and contingencies. Okay, so you should look at that, to have an insight into the recommendation. But here in this class, we're just going to look at provisions for income items and expense items fundamentally. Okay, so this is what I'm trying to say. For instance, let us say, okay, let's say debtors. Who are debtors? Debtors are are clients that are owing the business. So if you sold on credit to someone or to an individual, it is very, very, very odd, expected that the person pays. So that your customer that is owing you becomes a debtor. And we expect the debtor to pay us at when due. But, we can have activities, we can have events, that will result into maybe delay of payments, okay, or maybe not payment at all, so you can have various aspects, maybe leading into litigations and all that. Okay, but that's not what I want to discuss here. But I want you to understand that, sometimes relationship is very key too. So you still want to manage the debtors and then still keep them as your customers without also, having that huge loss in terms of non-payment of due invoices. So the debtor is expected to pay, and then sometimes the debtor don't pay all, so some parts are not paid, and then the business sometimes look at the significant effect of the item, and then if they see that fine, it's not that much, they can say, okay, let's forget about it. So it becomes a bad debt. So we can say a bad debt is what? A debt that has not or cannot be recovered. So once your client is owing you and then you cannot recover part of it or all of it, that part that cannot be recovered is called bad debt. So we refer to it as doubtful debt. That is, it's very likely that the money will not be collected or received from the debtor. Okay, so now sometimes because of the experience and the way that the business relates with its clients, it is also possible that you want to make provisions for bad debts. Bad debt is an expense. All right, someone is owing, person can pay, you're losing it, so that's an expense. Okay, so now you want to make provision for what? Bad debt. What I'm trying to say is that you're saying, okay, a debtor is owing you, let's say 100 million. Okay, and you're looking at the way the debtor settles his invoices over time, and you're saying, look, this guy, the way he behaves or the way he's behaving now is, is giving us the impression that he might not settle 100% of this debt. So you're saying, okay, let us make provisions for what? 5 million, okay, as what? Bad debt. So what we're saying is that we're not expecting 100 million from the guy again. We are expecting what? 95 million. So as such, we are making provision for what? 5 million to be bad. So this is going to be an expense. So we're saying that if you're making your provision for expenses, what you're trying to do is that you are trying to accommodate for a loss. Okay? To guide against the possible occurrence in the future. So you're looking at the past experience, you're looking at the way these guys are behaving, and you're saying, look, as it is, as we move on, this guy might not be able to settle all his invoices. So in the future, the occurrence might be that we might be losing a range of this amount of money. So in order for you to accommodate it and then give a fair view of the activities in total, you make provision for bad debt. So how do we account for bad debt? Remember that your expenses in your trial balance, this is what you must understand. Your assets, okay, are here. So your land and building, motor vehicle, equipment, they are assets, they are here. Your liabilities, they are here. Creditors, loans, accrued expenses, prepaid income and all that. Your liabilities are here. And then we have your income. What are income? Discount received, your sales and all that. They are credit here. So then we have what? Your expenses. Expenses are transportation, wages and salaries, printing and all that. They are here. So your assets are debit balances, liabilities are credit balances, incomes are credit balances, expenses are debit balances. So you must understand that when you're making provisions, you must be able to compare provision, okay, made at the beginning of the period and what? Provision made at the end of the period. These are the two things you're comparing. So if you have made provision at the beginning or at the end of, now let's say 2018, and then we're preparing account 2019. The end of 2018 is the beginning of 2019. The end of 2019 is the beginning of 2020. So if you're reporting in 2019, ending balance of 2018 at the beginning balance of 2019. So provisions made at the end of 2018 will represent the provisions made at the beginning of 2019. So what we're saying is that in the period that you're making the provision, you're going to compare the provision at the beginning of the period, let's say 1,000. Then provision at the end of the period, let's say 1,005. So this is what? 500 increase. Okay? So when there's an increase in provision for expenses, okay? When there's an increase in provision for expenses, the resultant effect on your what? Income and expenditure account, on your P and on your income statement is what? It's an expense. So what I'm saying is that when there's an increase in provision made for an expense, it will result into an expense. But if we now look at the next scenario, let's say here we still have 1,000, but the provision made at the end of the year is what? 900. You can see that there's a decrease. So when there's a decrease in the provision, it results into what? An income. So what I'm saying is that your provisions made for expenses or expense item can either result into an expense eventually or an income. So where the comparison between the provision made at the beginning of the period and the what? One made at the end of the period, when there's an increase, you can see there's 1,000 increase, from 1,000 increase it increased to what? 1,005. So the difference here becomes an expense item. Well, from here you can see that provision for expense at the beginning here is 1,000 and at the end here is 900. So you can see there's a decrease. So the resultant effect here is what? Is an income. So when you make provision for expense items, okay, and then there is an increase, it is expense. When there's a decrease, it is what? An income. But you must understand that the provision made at the end of the year must reduce the connecting item. Now let's say debtor. If the debtor value at the end of the what? Period, let's say is what? 50,000. Remember, we've made a provision at the end of the period of 1,005. Okay? So that means that this debtor value now will reduce from 50,000 to how much? 50,000 minus 1,005. Okay? That's about 48,500. So what we're saying is that we are expecting to lose, or we're making provision to reduce what? Debtor from 50,000 to what? 48,500. Okay? So because we have made a provision at the beginning of the period, and then there's another one at the end of the period, the difference is what we're going to what? Treat as either an expense or an income. So that's depending if it is increasing or what? Decreasing. Okay? Now, we can also make provision for what? Income items. Of course, income items are linked to liability items. Expense items are linked to asset items. So let's say creditors. Creditors are those that we are owing. You know, in this case now we talk about debtors. In this case, let's talk about creditors, those that we are owing. It's also possible that for some reasons we too might not be able to settle all the debt. And then it's also possible that, you know, based on relationship with them, we believe that there's a pattern of, you know, discount that we receive from them. So even if it has not been finalized, we can, you know, take step to accommodate or make provision for that discount because of what? Of experience. So if we know that at the particular period of time we expected that we take a particular discount, you know, on creditors' balance, you know, for instance, there are some organizations where they do what there's something called volume discount. That is, if you meet a particular, your vendors will tell you that if you meet a particular volume, they'll give you a particular discount. So if, for instance, your vendor is saying if you meet like 1 million, you get 10% discount. Of course, you're within the period and then you've met that target. You already know that you're going to enjoy 10% discount, even if you've not seen it, you know, finalized from the part of the what? Of your vendor. Okay, so you know that you're going to enjoy that discount because that has been the pattern or maybe the agreement. So they might not have finalized to credit you, okay, but you can make provisions for that because you already know the pattern. So that's the point I'm trying to make. So we're not saying if creditors, for instance, okay, say the creditor, that's those that are owing creditor, another name for creditor is payables, okay? Some even use vendor, all right? So you have to understand. Some use what? Vendor. So if creditors, for instance, they say 15 million, okay, because you have reached a particular benchmark, and then you expect that you should enjoy 10% discount on this. So if you're enjoying 10% discount, means you're going to pay this 15 million less 10%, right? And 10% of this is I think 1.5 million. So if you take out 15 million from 1.5 million, that will be the balance that you will pay. So if you say 15, okay, minus 1.5 from this 0, 0, 10 minus 5 is 5. 4 minus, is it 4 minus 1 here? That's 13,500,000. So you're reducing, okay, right? Yeah, that's it, 0, 0, 0, 5, 1. So you're reducing the value you are owing your creditors from 15 million to 13,500,000 because of the pattern. They've not given it to you, but you know that you're going to earn it. So you know there's a future event that will turn into an economic inflow. So you can decide to make provisions for that. Okay. Now, so making provisions for income, you're also going to compare provision made at the beginning of the period with provision made at the end of the period. I already explained end of period and beginning of period for you, so you have to understand the link. So in the case of creditors, okay, in the case of creditors, all right, so we say what? Provisions made at the beginning of the period. So we have provisions at the beginning of the of the period, okay? Let's say 500. Then provisions made at the end of the period. Let's say 800. You can see that there's an increase from 500 to 800. So where there's an increase, the difference, which is 300 here, becomes what? An income. But when there's a decrease, let's say 500 here reduced to 400. So the difference here was 100. So in this case, it becomes what? An expense. What I'm saying is that provisions made for expense item, when they increase at the end of the period, it's an expense. When they decrease at the end of the period, it's an income. Provisions made for income items, when they increase at the end of the period, it's an income. When they decrease, they become what? An expense. And then you must also adjust for the effect on the connecting item. So that means that at the end of the period here, this 800 here will reduce the creditor's value. So if your creditor there was let's say 10,000, that means what you report as creditor for the end of the period here will be 10,000 minus 800, okay, which is 9,200. But in this case, it will be 10,000 minus 400, which will be 9,600. Okay, so you must understand the effect in the profit and loss account and the effect in the statement of financial position. So this is just what they call it now, a background on making provisions for expense item and provisions for income item. And of course, I've already explained that in your trial balance, okay, your assets here debit, liability here credit, income here credit, expense here. So it's important for you to have provision for an expense item to be part of the trial balance before you make adjustment. So in that case, if you have provision for an expense item, okay, it becomes what? It will be a credit balance here. Okay? So, but if you have provision for an income item, okay, it will be what? A debit item. So these are basically beginning values. So the beginning value for provision for an expense item will usually be created in the trial balance. Beginning values for provision for income item will usually be debited in the trial balance. So if we look at this scenario, let's use this 1,000 and 1,500 now. So if we have this, let's say provision, okay, for let's call it bad debt. This is the beginning period. This is what we expect to see in the trial balance. So it is an expense to be credited. So you're going to say balance brought forward. How much? 1,000. Now you can see the end of the period here will be what you're going to have here, which is balance guidance 1,500. As you can see, this is 1,000 and this is 1,500. This is debit, this is credit. So there's a difference. So how do you balance up now? The difference here is 500, which would be in the credit side for you to agree with the debit side. So we're going to say profit and loss. How much? 500. So both sides 1,500. So in your P and L now, this will go to the debit side as an expense. So if we look at the same scenario here, okay, let's look at the same scenario here for the second scenario here. of course, you still have what? Provision. Okay? For bad what? Debt. Opening balance is still, which is balance brought what? Forward, 1,000. Then the closing balance, which is balance carried down, is how much? 900. You can see that it has reduced from 1,000 to 900. So the difference will be in the debit side. So we say profit and what? Loss. How much? 100. So now both sides becomes what? 1,000. 1,000. So this P&L now, which is 100 naira, will go to the credit side of the profit and loss. Of course, your income statement, incomes are on the credit side, expenses are on the debit side. So you can see the double entry effect on the provision ledger. So you have to understand this. Of course, there's a class on provisions. Okay, you can as well take that and combine it with this one to have an in-depth understanding of what we're talking about, or to have an idea of where we're coming from. So if you have questions, you can reach me on the numbers displayed. All right, let's take this short question so we have an idea of what I'm talking about. So we have the following trial balance relates to that of claims limited for the year ended at 2018. So we have admin and running expenses, we have sales, purchases, share capital, loan, creditors, VAT payable, bank, debtors, accumulated depreciation, and then we have non-current asset, and we have there to be the trial balance at 110,280,000. Yeah. Then we have additional information there. So what do we have here? I see a quick one there. The client's bad behavior with respect to settling debt intensified during the period, and as such, management decided to make 20% provisions to accommodate its effect on the cash flow. And then we have, it was also decided to make 10% provision for discount in settling payables, depreciate non-granted by 10%. So this is a very straightforward question. No headache there. So you're required to prepare the income statement and the statement of financial position for the what? Period. Okay? So let's quickly take this question to illustrate what we are trying to say in basic terms. Okay? So all right, so let's quickly do that. So the business belongs to Clint Limited. So I have, let's say, Clint. Okay. So what we have, and let's say income or statement, right? For the year ended at the 1st December 2018. Right? So we have our notes here. So we have turnover. Remember, this is not new, so you should understand this. Note 1. So let's come here. Call our notes 1. So what are the note 1 items here? I can see what? Sales. Very short. So this is just sales basically. So we have sales here. And the sales here is 72,600,000. So okay. So we have 72,600,000, right? So let's say 72,600,000, right? So next thing we say costs of what? Sales. That would be note what? 2. Right? So what are notes 2 here? So what I can see here is purchases, straightforward. So we have what? Purchases. Purchases here is how much? 35,600,000. So we have 35,600,000. So we take this out. 0, 0, 0. 12 minus 5 here will be 7. 6 minus 3 will be what? 3. So that's 37 million. So these are what? Gross profit. So is there any other income? There's no other income here. Oh, there is other income. Let's look at the adjustment. So let's say other income. Let's call it note 3. So we have note what? 3. All right. Look at what they said. They said it was also decided to make 10% provision for discounts on settling payables. Can you see that? Provision for discounts on settling. So when you settle payables and it's a discount, what's that? What? Payables are your creditors now. Remember another word for payables. We can use payables, we can use creditors. Some even use vendors. So what I'm saying here is that there's a discount on your settlement of payables. So with a discount on settlement of payables, it means that the vendors or the creditors are allowing us a particular discount. So from their perspective, discount, and from our perspective here, is discount received. So if the vendor, say we are owing our vendors, let's say 100,000, and then there's a discount of let's say 1,000. So that means we're going to be paying them or owing them 90,000. So the 1,000 here from our perspective is discount received. From their perspective there is discount what allowed. So that's a brief explanation. So let's go back to what the question said. Said it was decided to make 10% provision for discount in settling payables. So the question is payables or creditors according to the question. What do you have there? Creditors according to the question. Let's see. What do we have? Creditors according to the question. I can see 6,000. So creditors here is 6,000. Okay, so we have 6,000, and then they say we should make provision for 10%. So we'll say provision for discount was received. That will be 10 over 100 times 6,000. So what do you have? 600,000. This 6,000 here represents 6 million anyway. So it will be 600,000. Yeah. So what does this represent? What does it signify? Now we have to compare. Of course, this is at the end of the period. Okay. Now we have to compare with the beginning of the period. If you remember, I told you you have to have provision, at the beginning of the period. Okay. And provision at the what? End of the what? Period. Now at the end of the period, we have what? 600. But at the end of the period, what do we have? Let's check the question. So there's no provision at the end of the period. So that means there's an increase. So here, we can just say here to what? 0, right? So it has increased from 0 to what? 600. And I told you that when there's an increase for provision for what? Income items. Okay? The difference or the increased value is treated as an income. So here we can see there's an increase from 0 to 600. So difference will be what? 600, which would be what? An income. Okay, so that means here for other income, which is note 3, there's provision for what? Discount what? Received. Of how much? 600 what? 1,000. So is there any other income item here? There's none. Okay, so typically we can just conclude that this is the what? Other income. We have 600 here. So we have 00673. So this, we can just call this our gross income. Then we have total expense. Let's call that note 4. So we'll say note 4. Okay. So what do we have here as total expense here? We have 18 million. So what do we call that now? Admin and running expense. So we have admin and what? Running. So we have 18,000 here. Any other expense here? Okay. Okay, there's depreciation. Depreciate non-current by 10%. So what do we have? We'll say depreciation. 10 over 100 times what? The non-current asset item there. 33 million. So that's 33,000. So we have 33. Okay. 0, 0, 0, 0. So it's 3,300. So we have depreciation here, 3,300. Okay. What's the next one? So we have client's bad behavior with regard to settling debt intensified during the period. As such, management decided to make 20% provision to accommodate the effect on cash flow. So, who are the clients? Clients are the debtors. So we can say debtors, some use clients, some use receivables. Okay? So here, what do we have? Our debtor here, according to the question, what's the debtor value according to the question there? Debtor value according to the question, the debtor value, I can see 10,500,000. So we have 10,500,000. And so we should make provision. I mean, provision for what? Bad debt, of course. They are behaving badly. So that will be 10 over what? 100 times what? 10,500 over 1. So we have this. So what do you have there? 1050. 1,500,000. So, of course, I told you that you have to compare opening provision with closing provision. So we have provision at the beginning of the what? Beginning of the period. Provision at the what? End of the what? Period. So, is there anyone at the beginning here? No. So that's still 0. Then at the end, we have 1050. So that means an increase from 0 to 1050. I told you, if you're making provision for an expense item, okay, if there's an increase, you treat it as an what? As an expense. There's a decrease, treat it as what? As an income. So here there's an increase from 0 to 105. So the difference is what? 1050, right? So this becomes what? An expense, right? So we say provision for what? Bad debt. How much is that? 1050. Okay. Is there any other item here? So that's about it. Okay. There's no other item. So let's total expense there. What do we have? Total expense, what do we have? 0 plus 0 plus 0, we have 0. 5 plus 0 plus 0, we have 5. 0 plus 3 plus 0, we have 3. 1 plus 3, 4. 4 plus 8, that's 12. Right down 2, carry 1. So this is 2. But let's check with our calculator. So what do we have? 18,000 plus 3,300 plus 1050. 22,350. So that's our total expense here. What do we have? 22,350, right? Take this out. Okay. 37,600. We have 15,250. So this is your what? Profit or loss for the year, right? So if it's a loss, that means your expense will be more than this. But if it's a profit, your income more than your what? Expense. So in this case here, it's a profit. All right. So that's the first requirement. Income statements, right? So let's go. The next one says we should prepare what now? Statement of financial position. So let's do that somewhere here. Okay, taking this off. Okay, so let's go. Let's call it statement of what? Financial, excuse me, position as at what? 31st December 2018. Right? So we have this, we have this. So our assets now. So what are our assets? We have non-current assets. So, excuse me. So let's say notes here. So this is note 5 now. So let's say note 5. So what do you have? Non-current assets, right? According to the question, I think that's 33,000. So we have 33,000. So we take out accumulated depreciation, which would be the provision in the question, which is 5,000, okay, plus what's the one that we charge for the year? 3,300. So total is what? 8,300. So when you take that out, you have your what? Net book value, right? Or what they call carrying what amount. So what's the difference there? What's the difference? We have 33,000 minus what? 8,300. This is 24,700. So what you have here is what? 24,700. So the next one now is what? Current assets. Let's call that note 6. So we have note 6 here. So what are the items we have here? What are the current items here? I can see bank, I can see debtor. So what's bank here? Bank, according to the question, what do you have? Bank, according to the question here, what do you have? Bank here is 13,180. 13,180. What else? Debtors. Debtors. Remember, we made provision to reduce what we're expecting from our clients. So debtor here is 10,500 minus what provision we made? 1050. 1050. Okay, so we have 10,500, right? Minus what? 1050. So what do you have? 9,450. Any other item for current asset? None. So what do we have? Let's add up. 9,450 plus 13,180 is 22,630. Note 6, 22,630. Okay, so that's it. Any other asset? It could be another. There's no other asset here. So let's add up. So we have 22,630 plus 24,700. So what do I have? 47,330. So this is your what? Your total what? Assets. Okay? So the next one now, we have liabilities. Okay? So let's call this, what are liabilities? We have long-term liabilities or non-current liabilities. Okay? So what are long-term? Okay? Long-term or non-current. Let's call that note what? 7. So we call this note what? 7. So what's the item there? I can see loan. Loan there is 10 million. So our loan is what? 10 million. That's 10,000 there. So loan here is what? 10. So what's the next one? We have what? Short term. Okay, short term, or what we call current liabilities. Let's call that note 8. So let's say note 8. What are the items we have there? I can see VAT payable. VAT what? Payable. VAT payable have to be what? 1680. 1680. So what's the next thing there? Creditors. What's the creditors there? Creditors there, I can see 6,000. Remember, we made provision to reduce what we were expecting to pay our creditors. Okay, so that would be 6,000 minus 600 provision I've made here. Take that out. So what do you have? This will be 5,400. Yeah. Any other item there? No. So what do you have here? So we have a 1680 plus 5,400. 7080. So short-term liability will be what? 7080. So what's the next one there? Okay, reserves. Remember, when you make enough profit, okay, and you didn't share it among the owners of the business, or maybe the payment of dividends and all that, you know, it becomes a reserve. So that's is accounted for, depending when you may decide on how to use such surplus. So there's a profit made here for the year, 15,250. That's more like a reserve, okay? Since you didn't share it, okay? So let's call it note 9. So we have note 9 there. So we have profit for the year, 15,250. So let's have 15,250, right? So what's the next item there? Share capital. So we have share capital. How much is that? 15 million. Okay. So what do you have there? Okay. We have 10,000 plus 7,000. Okay. Plus 15,250 plus 15,000. So what do we have there? 7,330. So this is your what? Total liabilities. Of course, you know, liabilities can be, you know, debt of the business toward external parties and debt of the business to the owners. So that's what's behind it. So basically, standard of financial position showing, you know, the position of the business, okay, in terms of what? In terms of what? Assets and liabilities. So we can see that total asset here is 47,330,000. Total liabilities too is what? 47,330,000. Okay. So this is a quick question, okay, that helps us understand how to, you know, make provisions for expense items. So we used bad debt as a typical example, and then provision for income item we used discount receipt as a typical example. So of course your provisions, whichever way you would try to adjust for it, results into either an income or an expense, and I expect you to be able to raise the journals accordingly. So if you have questions, you can reach me on the numbers displayed. I'll be there to reply with the right answer. Don't forget, you can support us by paying to the account displayed, okay, or sponsor my textbook so we can distribute to students for free. Thank you. See you next class.